Welcome to this explainer. Today, we're jumping right in and kicking off our ASC 230 cash flows training. We're starting with section 1, getting right down to what the statement of cash flows actually is and exactly how it's structured. So let's start with a really intriguing question. Think about this. Can a business be wildly profitable on paper, but still completely run out of money? Well, the answer is a resounding yes. Actually, it happens way more often than you might think. You can have all the revenue in the world booked on your ledgers, but, if the actual physical cash isn't sitting in the bank account to make payroll on Friday, your business is in serious trouble. Which brings us to section 1, the one statement that shows real cash. To understand a company's true survivability, we literally have to look past the paper profits and focus squarely on the hard realities of the bank account. When you look at your core financial documents side by side, the difference is actually pretty striking. The income statement shows your revenue and expenses based on accrual accounting, meaning it's full of non-cash items and timing differences. The balance sheet, that's simply a cumulative snapshot in time of your assets and liabilities. But the cash flow statement, that is the ultimate truth teller. It shows the real cash that actually moved in and out of the bank. Check out this quote. The cash flow statement is the only financial statement that cannot be changed by accounting policy choices. Let that sink in for a second. While revenue recognition methods, or maybe how you calculate depreciation or handle accruals, can artificially boost your net income, they absolutely cannot change the hard reality of your cash balances. You either have the cash or you don't. It is a completely objective measure. Moving right along to section 2, why operating cash flow matters. Let's look at why lenders and investors scrutinize this reality so intensely, instead of just taking net income at face value. Operating cash flow is essentially your foundational metric. It's the starting point for key cash-based metrics like free cash flow, operating cash flow conversion, and debt service coverage ratios. Why? Because, as we just talked about, it's much harder to manipulate. This specific metric acts as the vital heartbeat of the business, representing the true cash generated by simply running the company day to day. If this heartbeat is weak, it really doesn't matter how amazing the income statement looks. But here is where things go seriously off the rails: misclassification. It's the absolute most common ASC 230 error. And we're not just talking about a simple administrative typo here. Putting the right cash into the wrong bucket causes these severe ripple effects that fundamentally change the entire narrative of the business. Notice the dangerous cause and effect happening here. If you accidentally push an investing outflow into the operating category, your operating cash flow gets artificially understated, which makes your performance and debt coverage look way worse to lenders. On the flip side, push an operating outflow into investing, and you're suddenly misleading lenders into thinking your free cash flow is better than it really is. Or if restricted cash is entirely excluded from your balances, the statement flat out fails to reconcile to the balance sheet, which triggers an immediate auditor adjustment. Nobody wants that. So how do we stop these massive distortions? Well, that brings us to section 3, the 3 structural buckets. To ensure total comparability, ASC 230 requires a highly rigid, non-negotiable blueprint. Every single cash flow statement has to follow this exact, fixed order without exception. Step 1, operating activities. Step 2, investing activities. Step 3, financing activities. It flows completely logically from what you do every day to how you invest for the future to how you fund the whole shebang. Let's break down exactly what goes into each bucket. So, bucket number 1, operating activities. This is literally the lifeblood of running the business. It captures your principal revenue-producing activities, the daily inflows from your customers, and the outflows for vendor payments, wages, and taxes. It also includes interest paid and operating lease payments. A really great rule of thumb to remember: if a cash flow isn't clearly investing or financing, its default home is right here in operating activities. Now, while the first bucket keeps the lights on, the second bucket, investing activities, well, that's all about the future. This tracks the cash you use for building or selling the company's long-term asset base. We're talking capital expenditures like buying new equipment or generating proceeds from selling assets. It also covers buying investment securities, making loans to others, or even executing full business acquisitions. And how exactly do you afford that future? That's your final bucket, financing activities. This shows exactly how the company interacts with its shareholders and lenders. It captures changes to your debt and equity. So, reporting debt proceeds and repayments, equity issuances, stock buybacks, dividends you pay out to investors, and the principal portion of your finance lease payments. Now, quick side note, if you operate internationally, there's a common trap you need to watch out for: foreign currency. The foreign exchange translation effect is actually never placed inside those three buckets. Why? Because it isn't an actual cash movement. It's just a translation effect of FX changes on your foreign cash balances. Since it's not a true cash flow, it is kept completely separate on its own reconciling line, way at the bottom, after the operating, investing, and financing sections are completely finished. All right, Section 4, the balance proof rule. Once those buckets and your FX adjustments are laid out, we arrive at the ultimate mathematical proof. Listen carefully to this insider tip, because it's a huge trap for reconciliation errors. Under ASU 2016-18, your ending balance on the cash flow statement absolutely must tie out to the total of all cash and restricted cash line items on the balance sheet, not just the unrestricted cash. If you don't combine both of those together, your statement will fail to reconcile, which pretty much guarantees an auditor adjustment. You have to prove exactly how you got from the opening total balance to the closing total balance. So we've mapped out the what and the how. Now that you understand this fixed blueprint and the incredibly high stakes involved, ask yourself this. If the cash flow statement is the ultimate, unmanipulable reality check, are you absolutely certain your classifications are telling the truth? Take a moment to really think about that. You should now feel super confident identifying those three fixed sections and understanding the severe consequences of misclassifying your cash flows. Get ready, because we are going to dive even deeper into the rules of restricted cash and key terms in our next explainer. Thanks so much for joining me today.